here. It's the first developing country that's chairing a major international economic initiative. And obviously we think that Korea is going to be playing a unique role. Dr. Eichengreen has pointed out some of the positive ideas that Korea has made so far in its initial start as chair, but most importantly has indicated that Korea needs to lead by example on a couple of issues. The other part of that is simply the G-20 process, and Mr. Roberts has pointed out some things that he finds fault with. There are obviously some very practical issues at hand of how to address these issues, and that's why we like to reserve the predominant portion of the program here to allow you, the audience, to question and to bring up issues and to see if we can't have a better understanding of not only Korea's leadership but the issue of the G20 and what they're tackling so far. So with that, let me open up the floor to some questions. If you'll just raise your hand. A number of people that I have not yet met in the audience, and don't be offended if I just point in your direction rather than call you by name. So, yes, ma'am. Now, the microphone will be coming your way, and if you'll just please identify yourself, and the floor is yours.
Yes, thank you. I'm Dr. Jill Marie Griesgraber. I'm the Executive Director of New Rules for Global Finance. And I was wondering if Mr. Roberts and Mr. Eichengreen might find some common ground in the proposal for a Chapter 11F mechanism for bailout. This is an excellent bankruptcy provision of the U.S. tax code, or U.S. code. And Dr. Eichengreen has talked about international protocols for workouts, but not working toward an international bankruptcy mechanism. And in my Walter Mitty dreams, I would hope that there could be an international bankruptcy mechanism that could apply not only to private corporations, but also in the event of national bankruptcy, that we have a protocol to help countries step down from the brink. But I think there may be some common ground in there for the two of you, but you might want to collect more questions. Thank you.
Well, let's just take this on at this point, if we may.
Well, in my Walter Mitty dreams, I too dream of a global bankruptcy regime, but I'm awake more or less at the moment. You know, I dream of a global money. I dream of many things, but Mr. Roberts is quite right. We live in a world of sovereign states, and I think that's why I would be prepared to defend the G20. The only way forward is cooperation among sovereign states. Not ceding sovereignty, that's not the idea at all, but agreeing on how sovereign states can work together to deal with problems like winding down big financial institutions that operate in multiple countries. So I'm not, on your other point, I'm not a bankruptcy expert, but there are a variety of problems with using the bankruptcy code to deal with large financial institutions, like what is the impact on the counterparties that make that complicated.
Yeah, well, I mean, I'm not the expert either, but Professor Taylor of Stanford is, I think, and argues for this 11F applied in the United States case to the United States too big to fail institutions. You know, in general, we argue at Heritage for just allowing the marketplace discipline to be felt, and that's been the problem. Is that there have been the market has not been allowed to punish people who have made major errors, and that has led to a lot of the socialization of these private debts and toxic assets being carried in these banks that are really not what they appear. And this article, I just refer you to the article that Professor Taylor believes that this 11F process in the United States at least could be manageable, and it could work without paralyzing the global system.
Okay, thank you. Front.
Paul Wanacott, University of Maryland. I'd like to ask you a question, Barry, about this whole question of of non-core or non-traditional assets held by banks. There are two ways of dealing with it, as you mentioned, one of which is capital, the other of which is a tax. And I'm sort of curious as to how you weigh the relative importance and desirability of those. You talked about capital adequacy being counter-cyclical, I think. Would you do the same thing with a tax? And one last question in this whole area. I think that you and Mr. Roberts were talking a bit differently. You seem to be talking about a tax on the quantity of assets, and he, I think, was talking about a tax on the transactions. And those, I think, are really quite different.
On the second point, I think that's right. We were focusing on different things. So I'm concerned. I'm concerned about too big to fail, and I think we need to take a variety of different kinds of measures to discourage banks from growing big. I am happy to use the T word. We need to use taxes because big banks are like big oil spills in the Gulf of Mexico. They do bad things to the economy, and that's where intervention in the form of taxation is appropriate. And I think even people who are temperamentally opposed to taxes and big government would agree on that basic economic principle. So I think one way of dealing with too big to fail is to require progressive capital requirements. The bigger you are, the higher your capital ratio has to be, your ratio of capital to assets appropriately defined. And there's a lot hiding under the appropriately defined caveat. Because we know that the financial system is strongly pro-cyclical, I would favor simple rules that ratchet up the capital ratio as a function of the rate of growth of the bank's overall balance sheet. And I think we can, the simpler the rule, the better. Then, on the other side of the balance sheet, how does the bank fund its operations? What we learned in 2007, 2008 is that not only capital but liquidity are important, and the seemingly liquid interbank market can become illiquid, creating serious risks to the whole financial system instantaneously. How do you deal with that? Well, if there is an externality there, and because of counterparty risk there definitely is, a tax on that form of liquid today, illiquid tomorrow form of funding is the right way to go. So I guess I see the tax on non-core liabilities as addressing first and foremost the liquidity problem, and the capital requirements as addressing as well the cyclicality and the tendency toward risk-taking when you're using other people's money.
Yeah, I would certainly agree that anything that can make the bigger banks more transparent to make and to have a connection, as the professor just argued, between the risk-taking and the responsibility and the accountability, I would support it. Obviously, we don't argue for big taxes at Heritage. We argue for cutting spending and writ large. But in terms of maintaining liquidity and not having the LIBOR market seize up overnight, I think the Fed and now the European Central Bank have apparently taken steps that have prevented that. But the capital requirements, I think, sensible capital requirements on a U.S. law basis, not international, but a U.S. law basis, I think we certainly support.
If I may, Barry, you talked very eloquently in terms of the bank tax and the unlikely event that we'll get any degree of consensus, particularly because of Canada, France, etc. Here at KEI about 3 weeks ago, we had a private roundtable for the Korean finance minister, and we had representatives from Canada, France, and Australia, particularly the